Welcome to GRE. I'm your host, Keith Weinhold. Most investors don't know that you can be the bank and hold a mortgage note for real estate. That's because financial companies would rather have you get into stocks or bonds. It's a little used but historically proven way to generate a stable, high-yield income stream for yourself with mortgage note investing and education about that today on Get Rich Education. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant-resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner in Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your eQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an eQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text eQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Durango City, Mexico to Durango, Colorado, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. You know, one thing I've learned from being a longtime real estate investor is that people are often surprised that you can be the bank. When you sell a property, you could offer seller financing to your buyer, and then the borrower will pay you their mortgage payments, and banks had nothing to do with it. Now, some people would rather buy a mortgage note from someone else to obtain a fixed yield income stream of 8%, 9%, or even 10%. In that case, you are not the landlord, you would just own the note. Consider how much better this is than the alternatives. Rising inflation has investors pining for a safe haven to protect their cash from declines in purchasing power. Let's compare real estate mortgage note investing, which is what we're discussing on the show today, to bond yields. You're getting between a 1 and 2% yield on a 10-year treasury note lately. That's less than inflation. What about your online-only savings accounts at places like Popular Direct or Ally Bank today? And what about money market funds? There, you're almost always going to get less than 1% anymore. There's also something like TIPS, Treasury Inflation Protected Securities. You don't receive any more in yield there than the inflation-adjusted principal. The inflation-adjusted return on TIPS, which is called its real yield, it's currently negative. That's because the Fed and inflation-fearing investors have poured tons of money into them for over a year now. Well, that keeps prices up and real yields down. Yeah, those TIPS yields, they might move closer to zero as well if we pass the inflation peak and the Fed starts tapering its bond purchases. What about cryptocurrency banks like BlockFi and Gemini? Their rates have gone down recently, especially for Bitcoin. Now, consider that last week we talked to Ridge Lending Group President Shaylee Ridge about how you can qualify for a mortgage loan in order to own property in your name that you rent out as a landlord to others and collect the rent payments. You're the borrower there. And that is a super familiar model here and to most anyone, and it's often a really lucrative one, and that's kind of situation normal. But see, not every borrower can get a loan because you remember last week we talked about how you need a certain FICO credit score and down payment and DTI and assets. Some people just don't have those things. Here we go, and this is really key to understanding real estate mortgage note investing. You are 100% opposite from being a borrower. You're 180 degrees different. You're the lender. You're the bank. This is some real education, some get-rich education coming. In real estate that's sold with financing, you have what is called a promissory note. It defines the terms of the loan, it shows the loan amount and interest percentage rate, and the payment amount, and the number and the timing of the payments. Okay, that is a promissory note. The note by itself is basically an IOU, and it contains the promise to repay the loan. That's what it is. The note is then secured by a mortgage. And what this does is that it ties the note to the property deed as a lien on the property. Okay, that's tying the note to the physical property. It ties this promissory note to the collateral. So just like borrowers send in their monthly mortgage payment, now you're on the other side of the transaction. You're on the receiving end. You essentially receive the mortgage payment. That's your stream of income now that you're acting as the lender or the bank. Well, now how would you ever get a hold of one of these notes? Well, banks often actually sell the notes to individual investors like you. Sometimes the bank's borrower has defaulted, meaning that they've missed the payments, making what is then called a non-performing note. That's what this would be called. Other times, banks might sell a note that's performing just fine with a regularly paying borrower. And there are reasons that a bank would want to sell a perfectly performing note. That bank might need to raise a lump sum of money for all kinds of reasons. Now, why would you ever buy a non-performing note, though? A note where the borrower has missed some payments? Well, that is because those notes often sell at a steep discount. You can get them for perhaps 60 cents on the dollar or less. And why in the heck would a bank sell you a non-performing note at a discount anyway, right? I mean, whenever anyone would sell you something for less than fair market value, you've just got to ask yourself why. If a car dealer wants to sell you a brand new S-Class Mercedes sedan worth $100K, and they want to sell that to you for just $60K, you have to wonder what in the heck is going on there. Is something wrong? Well, the reason that a bank would sell you a non-performing note, meaning a borrower's missing payments, the reason they sell you that at a discount is because since that homeowner now has a shaky payment history, which increases the chances that this could go toward foreclosure, well, banks just are not set up to do foreclosures very well. It's too costly for them. It's not the business that they're in. And another reason that a bank would sell you a mortgage note at a discount, say for just $60K when there's still $100K owed on the note, is that banks need to get these notes off their books because banks have to report these non-performers, and it can prevent the bank from getting future additional money to loan out to others if they have too many non-performing notes on their books. So those are two big reasons why banks sell real estate mortgage notes at a discount. And how are you doing by now? Are you keeping up with me? I know, being on the debt side rather than the equity side, it can take a little more time to sink in. Now, if you yourself own the borrower's non-performing note, you could foreclose on the property. After all, I said earlier that the note is tied to the property as your collateral. But hopefully you could first work out something with the borrower and modify their loan terms to something that's advantageous to both you and your borrower. And that way you can get the income stream that you prefer, yet your borrower homeowner could afford. And better yet, the homeowner gets to keep living in their home. I hope that's what you want to see. So what this does is this basically makes you a Lienlord, not a landlord. You own the lien. You own the right to take the house. With mortgage notes, you can get a cash yield of not those 1 or 2% that I discussed with those other investment vehicles earlier, but you can get 8%, 9%, even a 10% annual interest rate yield. And we're going to talk more about that, how that works with our guest today. Some investors like you want a fixed, predictable income, and you just can't get yields like this at a bank or in a bond. I'm really not sure why more people don't do this mortgage note investing. It might just be because the huge companies don't play in this space. Your after-tax yield for fixed income is better than nearly anything else that you're going to find in the investing world. Before we talk to our guest about it next week, Ristad real estate advisor Ken McElroy is back on the show with me yet again. We're going to talk about why rents in America are surging, why they're rising so fast, and also why after the CDC's eviction ban ended back on August 26th, why aren't there more evictions? People thought evictions would go up, but yet the street reality, what's really been happening is that evictions are flat or down even after the ban expired. That's next week with Ken McElroy and I. Today we're talking cash flow. Let's learn about mortgage note investing. We're talking today about a segment of real estate investing that a lot of people really aren't aware of. That is holding a mortgage note. With us today is Bob Fraser from Aspen Funds. Bob, tell us first about how you got into this private lending and mortgage note space.
Like a lot of folks in the note space, we actually started in real estate. My partner was a developer and got creamed in the Great Recession there, and also creamed before that in the S&L crisis. And after you get creamed a couple times, we may be thick-headed, but we can learn a trick or two. And he figured out the guys that did well were not the equity guys, but the debt guys. So determined to go figure out how debt works and how to get on the debt side of the equation to build kind of a more bulletproof kind of investment portfolio.
Yeah, now when we talk about getting on the debt side versus the equity side, oftentimes people on the equity side, they think of themselves as landlords, or maybe their property manager is a landlord. And when one gets on the debt side like this, one can think of themselves as a lien lord. So in this case, the investor holds on to that lien or that mortgage note. You could also call it an IOU. Rather than the investor getting a stream of rental cash flow like they do on the equity side as a landlord, over here they get a stream of mortgage payments from the homeowner as a lien lord on the debt side.
You got it exactly. It's very analogous to holding rental real estate, except take away the toilets, take away the renter that leaves, take away the rehab requirements and the maintenance requirements, et cetera. I don't get calls from borrowers. It's much more scalable business, but very analogous to rental real estate.
Now, maybe an individual investor is thinking, oh, well, that's something for the big banks to do. That's something for Wells Fargo or Chase or Bank of America to do here. Through the mortgage servicer, those banks get the income stream as de facto lien lords, but that's not necessarily the case. There are performing notes and there are non-performing notes.
That's right. So there's active markets for both performing and non-performing notes. For the sake of just simplicity, I'll talk about the performing notes mostly, and it is simply mailbox money, and they are for sale for purchase. And basically, we use a licensed mortgage servicer who literally the borrowers send their money to, and they collect the payments. They issue the 1098s, they issue the mortgage statements, just like you get for your mortgage, for the home you own. The issue is there's someone who actually owns that mortgage, and that's us behind the scenes. So it's just very, very passive until that loan goes default. Then at that point it becomes active.
Okay, default, meaning the point at which
they stop paying.
becomes non-performing. They stop paying. How do you get involved? And do you try to get involved in performing notes or non-performing notes, or both?
Yeah, we're in both strategies. So we have 4 funds that operate in the non-performing space where we buy non-performing notes and fix them, basically. So that's like rehabbers, or you buy a fixer-upper home and you flip it. Well, that's what that business is, except we don't buy real estate. We buy notes. We fix and flip notes. That's what that business is. And that buys non-performing notes. And then we have a performing note business that just is mailbox money. It's like rental real estate, where we collect the payments and send the money to our investors.
So how do you get in there? How do you become the note holder? Let's just say for a performing note.
So for performing note, you buy the note from a seller. You basically assign the note to yourself through an assignment and a launch that basically updates the note, assigns the note, just that big piece of paper that you signed when you closed your loan. I literally own those. Those, there's an launch to that says so-and-so bank assigns to Bob Fraser Incorporated, and that's filed with the county, recorded. That now I'm a legal owner of that note. I send that paperwork to my mortgage servicer, who sends the RESPA notices to the borrower. Say, stop sending your money where you were and send your money now to here. It's as simple as that.
So you have the connections with either banks that want to sell notes, whether they're performing or non-performing, or maybe someone that provided seller financing to a buyer, an occupant of a property. There's that side as well, where you can get in and find these opportunities.
That's right. We buy both, and we buy from other hedge funds who actually buy non-performing notes and then get percentage of them reperforming. So this is, they make a new terms to the borrower and season that note for a period of time, and then we'll buy them.
So I would think if you're buying performing notes, one would expect a smoother ride because that borrower, homeowner is regularly making their payments, and that would increase the propensity that they'll continue to do that. And then on the non-performing side, I would imagine it's a bumpier ride, but there's more opportunity because the homeowner has been in distress at some point if it's a non-performing note.
Absolutely right. In the non-performing side, it's much more complicated. There's a lot of issues you've got to deal with, including regulations, debt collection, licenses, and all the different licenses you need, as well as just understanding statute of limitations and doctrine of laches. I just found out a whole new legal word I didn't even know about after being in this business for 9 years. So there's always something, bankruptcy law, et cetera. So it's much more complicated, but there's more money to be made there. The reperforming side or the performing side, it really is just mailbox money. It's extremely boring. We like boring.
It's the kind of boring you like. It's just the steady, fixed income stream. Now, I think, Bob, a lot of people would start to reason that, wow, I wonder if there are more non-performing notes in the last year and a half or 2 years with what's happened in the pandemic and COVID and layoffs. We wonder if there have been a higher proportion of non-performing notes than performing notes. When we think about the fact that a lot of employees were laid off, but yet there was also stepped up unemployment compensation and forbearance options for those people. So are there more non-performing notes now than there were, say, 2 years ago?
No, less. Because what's happened is the normal market has been disrupted by the regulations. So all the forbearance plans means that they're not actually non-performing. So they're actually performing in their forbearance plan. You follow me? So they're not considered in default. So what happens, there's usually about a year delay where banks will try some basic remedial actions for a year. Then at some point they put them in a trash bin. And then at some point they take out the trash, and that's when they sell them to, trash collectors like us. Is a big delay, and we haven't seen any new flow from COVID.
Now, when we think about the strategy of someone that wants to obtain a mortgage note, that wants to obtain an IOU, we're talking about performing versus non-performing notes. It would seem reasonable that if one is in pursuit of a performing note, you just want to continue to get that predictable stream of income from that note. But are there people that go after non-performing notes because they're after a different profit motive, and that is so that they can obtain the property because that borrower defaults, so then that investor can later sell that property for a profit off the non-performing note?
Yeah, there are people that get in the non-performing note space in order to acquire property. We don't do that. We don't want to do that. We work very hard to keep people in their house, and that's what we want to do. There are people that do it for the purpose of taking properties.
A lot of times where one's profit comes in then is the discounting of a performing mortgage note. Can you tell us about that?
For a performing note, you'll almost always get them at a discount, especially if they're a reperforming note, which is our sweet spot. So these are notes that were once not being paid, but then are now being paid. They're called troubled debt restructures by banks, meaning that the borrower was in trouble and the note was restructured and now it's performing. But once a troubled debt restructure, always a troubled debt restructure. So it's kind of this black eye. It's this little fly that's in the ointment. And so ultimately they sell at a pretty deep discount. But the truth is there's nothing wrong with these notes. And so we'll buy those at pretty significant discounts. Typically, we'll buy notes at a 30 to 40% discount off what's owed. So the borrower owes $100,000, we'll buy it for $60,000 to $70,000.
Now, if I use let's say a 50% discount example, even though that might not be typical, it might be easier to do the numbers. If you were to buy a $100,000 note at a 6% interest rate, but you got that note for just $50,000, that being your discount, that therefore becomes a 12% yield, right? Because you still get the 6% yield on all $100K.
That's exactly right. So you earn a 12% yield. And that's in fact the way these notes are priced is based on cash yield. And we're regularly buying yields in the 12s and 13s is kind of the normal pricing for reperforming notes. It's kind of crazy, to be honest, that they're that discounted because they're worth more than that.
Well, you've been doing this for 9 years. You've got 2,300 notes now. So you've got a lot of experience here. I just sort of wonder more about what happens when a loan does come under distress, because apparently it has it at one time, even though now the borrower might be back in good graces. I would imagine there's a layer of protective equity there for you.
For sure. And discounts are magic, as you pointed out. But the other thing, so not only does it get yield boost, right? So instead of a 6, we're earning a 12 in your example. But let's say that borrower refinances. So they go to their bank and they go get a new loan. So the new lender basically takes out existing mortgages on that loan and they get a payoff. Well, because the borrower owes me 100, they don't know that I actually paid 50 for this note. So I actually make a profit. So I earn a 12% yield until I earn a 100% profit in a cap gain. That's pretty darn good. Then, as you just said, not to mention the fact that it's protective equity. So let's say it's a $100,000 note on a $150,000 house, but I only paid $50,000 for it. Well, I don't just have 50 in equity. I've got 100 in equity, right, above me. So it's protective. Not just the numbers, but all that. When you sign that mortgage, you go and got a new loan. How many pages was that note? How about that lien instrument, And it has all this language that protects who? It protects the lender.
Yep.
That's all mine. That's my contract that I bought. I am the bank. All that applies to me. So all those protections apply to me. It's a really good business to be in.
That is remarkable. This is a fascinating space. And the example that we're talking about here on that refinance takeout, when you got paid off, you got paid $100K for the note, even though you got it at a discount, only 50%. And you also had the income stream the entire time, in addition to this lump sum windfall. You're listening to Get Rich Education. We're talking with Bob Fraser of Aspen Funds. You can learn more about them at aspenfunds.us. You can understand why this is such a profitable space. I want to talk more about it when we come back. I'm your host, Keith Weinhold. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. A lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
Hi, this is Rich Dad Advisor Garrett Sutton. You're listening to the always valuable Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Bob Fraser of Aspen Funds about really a little exploited portion of the real estate investing niche, and that is investing in mortgage notes. And it's really illuminating to think about how things work on the debt side and how you do have a number of protections that way, but there are certainly got to be some risks. So, Bob, I'm wondering what really happens when that borrower stops paying the person that holds this IOU or this note. We've had COVID problems. You said that wasn't much of a thing, but really, what are some of the reasons for those distresses? We think about things like death and divorce and some of those other things. So what actually happens when a borrower stops paying?
Typically, the servicer will start sending late notices, just like you would get on your mortgage. And at some point, the note will be put into what's called loss mitigation. And that's where they begin collection efforts. And it is secured. So there is a piece of real estate behind that. And so one of the keys to being successful in this business is actually underwriting very carefully. As with many businesses, you make your money when you buy. So you have to buy right. You got to underwrite this and make sure you're comfortable if this note does end up in default, what your options are, and that you're going to be made whole by the property. You do want to take care of that. But generally, most servicers have a full collections option where they will simply up their fee schedule and they'll start reaching out to the borrower and attempting loss mitigation exercises, including settlement, refinance, bankruptcy, whatever it takes. In our case, we actually do that all in-house because we're way, way better at it than the servicers are.
Mortgage servicers, those companies that really collect payments and bill and invoice borrowers.
That's it.
Okay, so you're able to maintain more control over that if you do it in-house.
Yes. Well, we actually hire a mortgage servicer to do the bulk of the work, but anytime anything is in loss mitigation, we do that ourselves.
That would make sense because mortgage servicing companies typically have really low fees.
It's nothing. Yeah, we're paying $15 a month per loan. Typically, some of them go down as low as $8 a month. It's really very low cost. And it's the loss mitigation that's the real effort, the heavy lifting.
Okay, so you outsource the primary servicing. That would make a lot of sense. So when we talk about these notes and you get in position as a Lienlord, as I like calling it here, there's a first lien position that one could be in, meaning if a borrower defaults, that lender gets paid off first. And then one could be in a second lien position as well. Is there a preferable place to be? Because most people think you always want to be in first lien position, but I think there might be a second lien opportunity as well if the discounts on those notes are substantial.
Yeah, pretty much. When my partner first told me, about the business model, as soon as he said second liens, I was like, I'm out of here. This is garbage. You're talking about the smelly garbage at the bottom. I don't want that. And he said, give me 5 minutes and let me show you the model. And when he showed me, I about fell out of my chair. I couldn't believe this. So I'm super, super happy that people hate second mortgages because that makes the discounts all the deeper for me. Let me give you an example here. So let's say you have a $300,000 house, $100,000 first and $100,000 second. So the borrower owes $200,000 between the first and the second on his $300,000 house. He's got $100,000 in equity. Well, that $100,000 first mortgage, maybe it has 3.5% interest rate. Because it's covered by $200,000 in equity, I may not get a discount. Maybe I get a 1% or 2% discount on that. So I'm earning 3.5% on my money. Admittedly, almost no risk. Or I can buy the second mortgage. Well, the second mortgage typically has a higher coupon. So it may have a 6 or 7% coupon rate, so the interest rate. So let's say it's a 6% coupon, but as you said, I can buy that at a 50% discount, which for seconds is not that unusual. That's why I buy a $100,000 note for $50,000. I've got $150,000 in equity above my position. Am I really at risk in a $300,000 house? Is my risk way more than the first? I would tell you it absolutely is not. But I earn a 12% yield instead of a 3.5% yield. These things are actually inefficiently priced because of what you just said, people's bias against second mortgages. So to me, there is no such thing as a bad note. It doesn't exist. There's only a bad price. So I'll buy any note. I guess there are some notes I will not buy for any price. So I'll take that back. But really, 95% of the notes I will buy, I'll just adjust my price based on the mathematics behind the note. So based on mathematics, these things are massively underpriced second mortgages. So I would much rather own a second mortgage, a good second mortgage, than a first mortgage.
And that would be based on the yield that you can get, which is partially dictated by the discount and then the protective equity as well.
And the upside on exit. This last quarter in our performing fund, we're just coming up at the end of the quarter, we've just had about 30 loans that paid off. So these loans, so let's say you've got a rental portfolio with 1,000 homes in them. This is what we have, except we have a performing mortgage portfolio of 1,000 notes. Except with us, these homes sell themselves once in a while. So for us, whenever someone refinances or sells the home, which we're not in control of, we have zero control over that, but we get a check. The new lender sends us the money and liquidates our position, but we recover our discount. So if you bought $100,000 for $50,000, I get a $100,000 check, $50,000, which is profit. Second mortgages have not only higher yield, they have protective equity, as you point out, but they also have upside. They have capital gains at the end.
you're getting these rather predictable streams of income, and then once in a while you get this surprise lump sum from the title company
Surprise.
when that borrower refinances or it closes.
Every day I get these deposit notifications, and I'm telling you, little Christmas alerts. $124,000 deposited in your account today. It's like, it's kind of fun.
Does anyone in the United States enjoy visiting their figurative mailbox any more than Bob Fraser? I sure don't know.
I really do.
Glad that you mentioned the exit strategy, because that is an important part of understanding the life cycle of these notes. So I know that you do have a way for everyday investors to get involved. But before I ask you about that, is there any last thing that you want to tell us about how this works? Because it's a space that a lot of us don't deal with very often.
You got to dot your I's and cross your T's. You need to be aware of some of the regulatory issues, and you could talk to an attorney about any of those in your state, and your servicers will keep you out of trouble if you have a good servicer. So it's super important to get a good servicer. Really, it's just do your underwriting is the key. Do the underwriting and look at all your different scenarios and make sure that you're comfortable.
Now, often individual investors want to participate in this because at this time, it's more difficult with interest rates being lower than ever to get a good fixed yield anywhere, from the bond market to an online savings account to even crypto banks have seen their yields become so compressed in just the last year. And most people are starved for fixed yield.
It's nuts. Yeah. So we have our reperforming fund is paying 9% on a monthly basis, 9% annual paid monthly. And it's a great yield. And it has liquidity provision. So what's interesting is because we have so much liquidity in this fund, all these notes liquidating all the time, we pass that on to our investors. If you want your money back, just give us 90 days notice. There's no guarantees of liquidity, but we've never failed in a liquidity request yet. So it's one of the interesting things. There's two strategies, right? You can go to a fund like ours, but it is only for accredited investors, and that's the SEC and that kind of thing. Or you can go buy individual notes, which you definitely can learn how to do that successfully. And I know a lot of people that do.
Okay, so for people that want to get more into the nitty gritty, they can get an individual note through you. But I would imagine that most of your traffic kind of wants that smoother ride by being in the funds.
We don't sell individual notes to investors, but there are third-party websites to do that. We use a company called PaperStack to sell any notes that we want to sell on an individual basis. We sell them usually through PaperStack. They're friends of ours, but we don't get a commission for that or anything. They have a whole, bunch of sellers that offer notes for sale, a bunch of buyers. It's kind of an exchange, a note exchange.
Okay, so you package these into funds for individual investors. How many notes might there be in one fund, Bob?
Our reperforming fund, I think, has 1,200 notes right now in it.
Wow, that would be quite the smooth ride one would expect.
Exactly. You get geographic diversity, you get kind of property diversity, state diversity. So that's honestly the best way, where there's really no surprises.
And this is United States single family homes up to apartments. Is it residential only? Or?
It's residential only, resi only, and owner occupied only. We do have a few non-owner occupied that slip in there, but owner occupied, which is the super secret sauce. So a hard money loan site, like First Trust Deeds, there's a lot of those out there where you can invest in hard money funds, but you're investing in maybe single family homes, but your borrower is an investor. And if an investor gets upside down in their property, so they owe more on it than it's worth, guess what they do? They hand it back to you and make it your problem. I don't have that problem. This is home sweet home. If your home, Keith, you get underwater in your home, are you going to say, oh, honey, we're underwater, I'm going to give this back to the bank? You don't do that. No one does that because, well, you got kids going to school. You got a wife that you try to keep happy. People don't do that. So home sweet home is the key. And I can show you actually default rates are more related to the job market than the property market, property prices. So we try and get out of the whole equity business in the sense of the risk factors. It's much better business to be in the owner-occupied residential real estate market.
Now, as far as an individual investor getting involved, you told us how they need to be accredited. Is it a certain minimum time period that one has to have their money in? You talked about the 90-day liquidity for when wants to cash out. So tell us some more about those investor things to expect, Bob.
We have a 1-year lockup, so you can't get your money for a year. But then after that, it's if you want your money, take it out. That's not very onerous. We have way more people trying to get their money into our fund than getting money out.
Yeah, that's the kind of problem that you want to have. And did you mention the minimum investment amount?
Minimum investment is $50,000.
Well, yeah, I think this is really going to be of interest to a lot of people to get that fixed stream of income. If one wants to look into this and maybe get started in the fund, what's the best way for them to do that, Bob?
AspenFunds.us. That's Aspen like the tree, FUNDS.us.
Bob, this has been fascinating to learn about getting on the debt side.
And doesn't answer the plug toilet calls.
That's right. Yes, you don't have dozens of tenants texting you either. Bob, it's been great. Thanks so much for coming on the show.
Pleasure to be here with you guys.
Oh, yeah, some good education supplemented by an experienced operator today. Now you have a better idea of what happens to your mortgage payment that you send in yourself as well. But getting back on the debt side here, what banks typically do is that they take a loan and then they make a loan. So banks take a loan from a depositor and then turn around and make a loan to someone else at a higher interest rate than they just took that loan for. So now what you can do is that you can either learn the nuances of mortgage note investing yourself, since you have this overview, or really what you can do is make mortgage note investing, I guess, turnkey, if you will, and come alongside someone like Bob and Aspen Funds to get that 9% return. So here's what you can actually do along the lines of take a loan and make a loan is that if you have $100K of equity in a property, you could pull it out at, say, a 3% interest rate and invest it for, say, 9% here. Well, that's a 6% spread. That's another $6K per year of income for you. And yeah, that's an additional $500 per month in an income stream you just created arbitrage. But yeah, sorry, you must be accredited if you want to do it through Aspen Funds. Now that you know where the yield comes from, you might feel better about coming alongside them. 9% annual yield, paid monthly, and after a year, expect 90-day liquidity. If you think that this can benefit you, go ahead and learn more at aspenfunds.us. Ken McElroy and I together again next week talking about the rental housing market and a lot more. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.